You walk into your bank on a Tuesday morning to deposit your paycheck. The teller smiles, processes your deposit, and hands you a receipt. You feel good. Your money is safe, growing steadily, and the bank is looking out for your financial future, right? Wrong. What if I told you that in the next 20 minutes, I'm going to shatter every assumption you've ever had about how banks actually work and what they're really doing with your hard earned cash? My name is Nick, and I've spent the last decade digging into the mechanics of money that most people never see. If you've ever felt like the financial system is designed to keep you running in circles while others seem to effortlessly build wealth, or if you've suspected that there's a playbook the wealthy follow that nobody ever taught you, hit that subscribe button and buckle up. Because today, we're not talking about budgeting tips or side hustles. We're talking about the fundamental truths about money and banking that could change how you think about every dollar you earn. Here's what most people don't realize: the banking industry operates on principles that are completely different from what they tell you in their marketing brochures. They're not lying to you exactly, but they're definitely not telling you the whole story. And once you understand the real game being played, you'll never look at a bank statement the same way again. Let's start with something that's going to sound obvious, but will blow your mind when you really think about it. Your bank account preserves your money, but it almost never grows your wealth. I know, you're thinking, Nick, I get interest on my savings account. But let's do some math that'll make you want to throw your savings account out the window. The average savings account in America pays about 0.4% interest annually. Meanwhile, inflation over the last decade has averaged around 2 to 3% per year. Do you see the problem? You're literally getting poorer every single year by keeping your money in the bank. That $1,000 you had in savings 5 years ago, it can buy about $850 worth of stuff today. Your bank didn't tell you that when they opened your account, did they? Banks design savings and checking accounts for three things: safety, liquidity, and payments, not wealth building. They want your money to be there when you need it for rent, groceries, or that emergency car repair. That's valuable, don't get me wrong. But if you're keeping significant money in cash for years thinking it's growing your wealth, you're playing a game you cannot win. The bank knows this. They're counting on you not knowing this. Here's where it gets interesting. While your money sits there, earning basically nothing, your bank is making a fortune off of it. When you deposit money into your account, you're essentially giving the bank a loan. And what do they do with that loan? They turn around and lend it to other people at much higher interest rates. This is how banking works at its core. You give them money for free, essentially, and they lend it out at 5, 10, or 20% interest. The difference between what they pay you and what they charge borrowers is called the net interest margin, and it's how banks make most of their money. Your checking account balance becomes someone else's mortgage, car loan, or business loan. Now, before you get angry about this, understand that this system isn't inherently evil. It's actually how modern economies function. Your deposits help finance homes, businesses, and economic growth. But the banks aren't exactly advertising this relationship in their your money, your future commercials, are they? This lending system does something even more fascinating that most people don't understand. Banks don't just move existing money around. They actually create new money through something called fractional reserve banking. When a bank makes a loan, they don't take that exact money from your account and hand it to the borrower. They create a new deposit in the borrower's account while keeping your deposit intact. Let's say you deposit $1,000. The bank keeps a small fraction as reserves and can lend out the rest, or when they make a $900 loan, they create $900 in the borrower's account. Now there's $1,900 in the system instead of your original 1,000. The borrower spends that money, it gets deposited somewhere else, and the cycle continues. This is how the money supply grows. This isn't some secret conspiracy. It's regulated, documented, and taught in every economics textbook. But most people have no idea it's happening with their money. You might think the Federal Reserve forces banks to keep 10% of your money in the vault, but in 2020, they quietly changed that requirement to 0%. Legally, they don't have to keep any of your deposit waiting for you, but the fact remains, your deposit becomes the foundation for creating much more money in the system. Now, let's talk about something that's probably costing you thousands of dollars a year without you even realizing it: credit cards. Banks love to market credit cards as convenient payment tools with rewards and protection. And they are those things. But what they don't emphasize is that credit cards are also the most profitable product banks offer. And not because of annual fees or merchant processing. The real money comes from people who carry balances. If you pay off your credit card every month, you're actually a terrible customer from the bank's perspective. They call people like you deadbeats in the industry. Seriously. You use their services, get rewards, and pay nothing in interest. The bank makes maybe 1 to 3% from the merchant when you swipe, but they have to pay for rewards, fraud protection, and customer service. The customers banks really love are the ones paying 18 to 29% interest on balances they carry month after month. Those interest payments are pure profit after accounting for defaults. A customer carrying a $5,000 balance at 20% interest is paying $1,000 a year just for the privilege of owing money. This is why credit card companies spend billions on marketing and why you get pre-approved offers in the mail constantly. They're not hoping you'll use the card responsibly and pay it off each month. They're hoping you'll get comfortable carrying a balance and paying them a premium for years. Here's something that might surprise you about how borrowing actually works. The interest rate you pay on any loan isn't arbitrary. It's based on a sophisticated calculation of risk. Banks look at your income, your credit history, your assets, and dozens of other factors to determine how likely you are to pay them back. If you have a stable job, significant savings, and a perfect payment history, you're a low risk borrower. The bank can offer you lower interest rates because they're confident they'll get their money back. But if your income is unstable, you have little savings, and you've missed payments before, you represent a higher risk. The bank charges you more to compensate for the possibility that you might default. This is why wealthy people often get better deals on everything from mortgages to personal loans. It's not just because they have connections or special treatment, it's because they represent lower risk to the lender. They have assets the bank can claim if things go wrong, and they have proven track records of managing debt responsibly. Understanding this changes how you approach borrowing. Instead of getting frustrated that you can't get the same rates as wealthy people, you can focus on building the financial profile that qualifies for better rates. Higher income, more assets, better credit history. These aren't just nice to haves. They're tools that save you money every time you need to borrow. But here's where it gets really twisted. The wealthy don't just get better rates because they're lower risk. They use debt in ways that would make your head spin. While you're trying to pay off your credit cards as fast as possible, rich people are borrowing money specifically to get richer. Let me explain this backward logic that'll make you question everything you thought you knew about debt. Say you're wealthy and you own $1 million worth of stock that's been growing at 10% per year. You need $200,000 for something, maybe to buy another property or start a business. What do most people think you do? Sell $200,000 worth of stock, right? Wrong. That's what poor people would do. Like, rich people go to their bank and say, I'd like to borrow $200,000 and I'll put my stock up as collateral. The bank looks at this deal and thinks, this person has $1 million in assets, wants to borrow $200,000, and we can seize the stock if they don't pay. This is the safest loan we'll ever make. So they offer them a rate of maybe 4%. Now here's the genius part. The wealthy person keeps their stock, which continues growing at 10% per year. They pay 4% interest on the loan, but make 10% on the assets. They're essentially getting paid 6% to borrow money. Meanwhile, they never sold their stock, so they never triggered capital gains taxes on the profits. This is called borrowing against assets, and it's how the ultra wealthy can live lavish lifestyles while technically having very little income on paper. They're not selling anything, so they're not paying taxes on anything. They're just borrowing against their growing pile of assets. When they die, their heirs get what's called a stepped up basis, meaning they inherit the assets at current market value and can sell them without paying capital gains taxes on the decades of growth. Banks absolutely love these customers because they represent almost zero risk and provide steady interest income. Meanwhile, the same bank is charging you 22% on your credit card balance because you don't have $1 million in stock to put up as collateral. This brings us to something even more mind-bending that most people don't know exists. There's an entire financial system that operates parallel to the one you know about. It's called offshore banking. And before you start thinking this is some illegal conspiracy, let me be clear. Most of it is completely legal and regulated. It's just not advertised to regular people because regular people don't have enough money to make it worthwhile. Here's how it works. Many countries have banking systems designed to attract foreign money by offering favorable tax treatment, privacy, or regulatory environments. These aren't necessarily tax havens in the stereotypical sense. Switzerland, Singapore, Luxembourg, and dozens of other countries offer legitimate banking services to international clients. Wealthy individuals and corporations use these systems to legally minimize their tax obligations. They're not hiding money or breaking laws, they're using the fact that different countries have different tax codes and international agreements that allow for legal tax optimization. Your bank probably has relationships with banks in these countries and can facilitate these arrangements for clients who meet minimum asset requirements. The reason you've never heard about these services isn't because they're secret. It's because most banks don't offer them to customers with less than $1 million in assets. The paperwork, compliance costs, and regulatory requirements make it unprofitable to offer these services to smaller accounts. But here's what's really interesting about this system. Banks make enormous profits facilitating international finance for wealthy clients. They charge management fees, currency exchange fees, and advisory fees that can add up to hundreds of thousands of dollars per year per client. These high margin services subsidize the basic banking services offered to regular customers. In other words, the wealthy clients, using sophisticated international banking services, are partially funding the free checking accounts and low cost services that regular customers receive. It's a cross subsidy that most people never think about. Now, let's talk about something that hits closer to home for most people: mortgages. Banks have convinced an entire generation that buying a house is the ultimate financial goal and that mortgage debt is good debt. While homeownership can build wealth over time, the math behind mortgages reveals some uncomfortable truths that banks don't emphasize. When you take out a 30-year mortgage, you're not just borrowing money to buy a house, you're committing to pay roughly double the purchase price by the time you're done. A $300,000 house with a 6% mortgage means you'll pay about $600,000 total over 30 years. The bank gets $300,000 in interest for the privilege of lending you money to buy an asset that you maintain, insure, and pay taxes on. But here's the part that really stinks. If for the first decade of your mortgage, almost everything you pay goes to interest, not principal, your monthly payment might be $2,000, but only $300 of that actually goes toward owning more of your house. The rest is pure profit for the bank. You could make payments for 8 years and still owe 90% of the original loan amount. Banks structure mortgages this way intentionally. They want their money back first with interest before you start building significant equity. This front-loaded interest structure means that if you sell or refinance within the first 10 years, which most people do, the bank has collected the vast majority of the interest they'll ever get from you while you've built very little equity. This is why banks spend so much money on mortgage marketing and why they make the application process as smooth as possible. They've created systems to approve you quickly, handle all the paperwork, and make you feel like homeownership is within reach. They're not doing this out of kindness. They're doing it because mortgages are incredibly profitable products. And here's something that'll really bake your noodle. Banks don't want you to pay off your mortgage early. When you make extra principal payments, you're destroying their profit model. That's why they don't aggressively promote or make it easy to pay extra toward principal. They'd much rather you refinance every few years, resetting the interest clock and generating new fees. The entire system is built on a foundation that most people never question. We assume banks are stable, trustworthy institutions that will always be there when we need them. But the reality is that banks operate on a model that would terrify most people if they really understood it. Remember when I mentioned that banks operate on a model that would terrify most people? Well, here's the part that should keep you awake at night. Banks don't actually keep your money sitting in a vault somewhere. In fact, they only keep a tiny fraction of deposits on hand at any given time. This isn't some dirty secret. It's literally how the entire banking system works, and it's called fractional reserve banking. Let me put this in perspective. If you and 9 of your friends each deposited $1,000 at the same bank on the same day, the bank might only keep 1,000 of those $10,000 in actual cash reserves. The rest gets lent out immediately. So what happens if all 10 of you show up tomorrow wanting your money back? Well, that's when things get interesting, and not in a good way. This is exactly what happened during the Great Depression. People lost confidence in banks, everyone tried to withdraw their money at once, and banks literally ran out of cash. Entire institutions collapsed overnight. Your grandparents probably had stories about this, assuming they were brave enough to talk about it. Now, before you panic and rush to withdraw all your money, understand that this system is backstopped by several layers of protection that didn't exist in the 1930s. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per account. The Federal Reserve acts as a lender of last resort to banks that need emergency cash, and there are strict regulations governing how much banks must keep in reserves. But here's what they don't tell you in those reassuring FDIC commercials. This entire system depends on one thing: confidence. As long as most people believe their money is safe and don't all try to withdraw it at once, everything works fine. But if confidence breaks down, even the strongest bank can fail within days. It's a psychological game as much as a financial one. And banks know this. That's why they spend billions on advertising designed to project stability and trustworthiness. Those marble columns, mahogany desks, and serious looking people in suits aren't accidents. They're props in an elaborate theater designed to make you feel confident about leaving your money with them. The regulatory system that protects deposits also creates some perverse incentives that most people don't think about. Since deposits are insured, banks can take bigger risks with your money without worrying about you withdrawing it if things go wrong. If their risky bets pay off, they keep the profits. If their bets fail, the insurance fund covers your losses while the bank's shareholders and executives still might walk away with millions. This moral hazard problem contributed to the 2008 financial crisis. Banks made increasingly risky loans because they could sell those loans to other institutions, removing the risk from their books. When the whole system collapsed, taxpayers ended up bailing out the banks while millions of people lost their homes. Here's something that'll really twist your brain. The same banks that nearly destroyed the economy in 2008 are now bigger and more powerful than they were before the crisis. They paid some fines, fired a few executives, and went back to business as usual. Meanwhile, they've convinced the public that new regulations have made everything safe again. But those regulations have also created new ways for banks to extract money from customers. Compliance costs have to be paid somehow, and guess who ultimately pays them? That's right, you do. Through higher fees and lower interest rates on deposits. The regulatory burden has essentially become a tax on banking that gets passed through to consumers. This brings us to one of the most insidious ways banks separate you from your money, and it's something most people never even notice, like foreign exchange fees. Every time you use your debit or credit card in another country, or buy something online from an international company, your bank charges you a fee to convert currencies. These fees are typically 2 to 3% of the transaction amount, and banks justify them by saying they need to cover the cost and risk of currency conversion. But here's the dirty secret. The actual cost of converting currencies for large financial institutions is a fraction of a percent. The rest is pure profit. Here's the continuation of the script. Banks make this sound complicated, but it's actually quite simple. They buy currencies in massive quantities at wholesale rates, then sell them to you at retail rates. It's like buying a candy bar from Costco for 50 cents and selling it to you for $3 because you needed it right now and didn't want to drive to the warehouse store. The beautiful part, from the bank's perspective, is that most people don't even notice these fees. They see a charge for 50 euros on their statement and assume their bank converted it at the fair market rate. They have no idea they just paid an extra $2 for the privilege of buying something in another currency. This currency conversion scam extends to online purchases too. Buy something from a European website for 100 euros and your bank might show the charge as $108 instead of $105 at the actual exchange rate. That extra $3 disappears into the bank's pocket and most people never realize it happened. Travel rewards, credit cards love to advertise no foreign transaction fees as a major benefit. But think about what that tells you. If waiving these fees is considered a premium feature worth marketing, how much money are banks making from people who don't have those cards? Now let's talk about the final piece of this puzzle, the thing that ties everything together and explains why banks can get away with all of this. The truth is that most people are financially illiterate, and banks work very hard to keep it that way. Financial literacy isn't taught in most schools. When it is taught, it's usually basic budgeting and saving advice that doesn't touch on how the monetary system actually works. Banks love this because informed customers are dangerous customers. Informed customers ask questions, shop around for better rates, and don't fall for fee-generating products. This is why banks sponsor financial literacy programs that focus on personal responsibility and basic money management rather than how banking actually works. They'll teach you to balance a checkbook, but they won't explain how fractional reserve banking creates money. They'll encourage you to save, but they won't mention that inflation is eating away at your purchasing power. Banks also benefit from the complexity of their own products. Try reading the terms and conditions for your checking account sometime. It's deliberately written in legal language that obscures rather than clarifies. Most people give up after the first page and just trust that the bank has their best interests at heart. The same complexity appears in investment products banks sell. They'll offer you a certificate of deposit that pays 2% interest, which sounds reasonable until you realize that similar government bonds are paying 3% with the same level of risk. But bonds require you to understand markets and make your own decisions. CDs are simple and familiar, so people choose the worse option. This brings us to perhaps the most important realization of all. Banks aren't evil and they're not running some massive conspiracy against regular people. They're businesses operating within a system that incentivizes them to maximize profits while providing services people need. The real issue is that most people don't understand the rules of the game they're playing. They make financial decisions based on emotions, convenience, and incomplete information rather than understanding how money actually works. Banks simply take advantage of this ignorance through legal and regulated means. Understanding these 10 secrets doesn't mean you should stuff cash under your mattress and never use a bank again. Banks provide valuable services that modern life requires, but knowledge is power. And now you have the knowledge to use banks strategically rather than being used by them. Use banks for what they're good at: safety, convenience, and payments. Don't expect them to build your wealth. Understand that every product they offer is designed to make them money, not you. Shop around for rates and fees, read the fine print, ask questions, and remember that the friendly teller smiling at you works for the bank's shareholders, not for you. The next time you walk into that bank to make a deposit, you'll see it differently. You'll understand that you're not just a customer, you're a resource being harvested, and that changes everything about how you approach every financial decision you make. So there you have it. 10 secrets that banks would prefer you never learned. If this video changed how you think about money and banking, share it with someone who needs to hear this. Hit that subscribe button if you want more content that exposes the hidden mechanics of wealth. And remember, the best defense against being played is understanding the game.